Hello and welcome to the latest edition of Allsop PropChat, the Allsop podcast, all things property. Today I am joined by, well, it's quite a thriller, Michael Linane and William Shoebotham, who both, well, they'll tell you more about themselves in a minute. They both work in our residential investment team, covering a very wide variety of assets and property types all over the country. So before we get underway, I thought it'd be a good idea for you guys to introduce yourselves about your background, how long you've been at Allsop and what you do. So Will, you first.
Yeah, so I've been at Allsop for I think 16 years now. Joined as a graduate on the graduate scheme, so I rotated around the business. I went on to comment to Grange for 6 months and then joined the Resi investment team 14 years ago now, during which time I was sort of focused. Well, initially I was looking at sort of student development and investment, but then probably about sort of 2-3 years into my sort of post-qualified career, focused on the investment side. So yeah, in the team for 14 years now.
Michael, I'm guessing slightly longer.
Yes, it's before you were born, Rich.
Yeah.
Late 90s, you wish. Qualified in 96, and I have worked across different disciplines in the business, starting in valuations, then moving on to the residential auction team with your good self, setting up a business in Ireland, and latterly the last 10 plus years running the investment, student and development teams, which we call RTLM, Residential Transactional Living Markets.
There we go, easy, that slips off the tongue nicely. You actually trained me up in auctions, but we won't hold that against you. In terms of, you guys have had an absolute incredible year in terms of the last financial year in every respect of number of deals, amount raised and property types you're doing. Sure. Can you just touch on a little bit of that, how that year's been, and then we'll go into whys and wherefores and other interesting parts of that year? Yeah,
so look, I think to sort of compare and contrast it to the previous year, as you sort of alluded to, we run through financial years. In 24 to 25, around 31 transactions, which amounted to about £310 million worth of kit. And this is just purely on investment. This is putting the student and development to one side. But then in the last financial year, 25 to 26, a similar amount of transactions, around 34. But in terms of the amount transacted, the total was over 510 million.
Wow.
So yeah, look, it was a really good year for us, certainly on the investment side, but that was sort of echoed through to the student and development as well. And that's really focusing on what we do, which is really the London market and anything really up to the Midlands, sort of Birmingham, which is where I came from originally, and south of that and outside of that, our Leeds team are doing a hell of a lot too.
Yeah. So, I mean, more detail-wise, why have you had such a good year? Because it's different in the auction world often, but when you look at the wider market, local estate agents and some of the big transactional teams within Allsop in both sectors, commercial and residential, it's been really attritional and tough for the past few years. Why is it so different?
I guess it's market intel and experience, as you've already referenced. I've been around a bit, so as Will. The market is difficult. There's no getting away from that, but I guess the asset class is particularly popular, and as many know, it's inflation proof. It's a hedge against inflation, and it has its fan base, and we know where that fan base is. We know who wants to buy the stock, and we know where to find it. Hence, a lot of the hard work and effort that we've been putting in over, actually quite a long haul of difficult years. We've built our pipeline and our knowledge base accordingly, and it has come together, and particularly over the last 18 months, I would say, and continues to go in the same direction.
I think we found in the last year that our average lot size, whether it be on the sales or acquisition side, went from 10 million to 15 million. So it's quite a jump. It's up by about sort of 65% in terms of what we did in the previous year. And a lot of larger deals that we were working on, which we have been working on for sort of up to 18 months, came to fruition last year. We sold 1,000 units in Birmingham, around 700 units that Michael dealt with via the Home REIT portfolio. And a big thing for us last year was acquisitions, around £250 million worth of acquisitions. And it comes back to Michael's point. I think it's because we're in the market with the amount of instructions that we facilitate, we know who the hot money is. And as we find in every year, 2 or 3 people sort of come out of the woodwork, which we might have been dealt with previously, or actually might be new entrants to the market. And as soon as we understand who those people are, to be honest, we jump on them pretty quickly, and we'll not only sell to them, but we'll act for them on the acquisition side. And I think what we found last year was that, the acquisitions was just a really fruitful area for us on not just the C3, but PD and all sorts of asset types within the resi space.
But in terms of, when you speak to a lot of agents, everybody in the market that we deal with, is that the disparity between what buyers are prepared to pay and what sellers are prepared to sell for is one of the biggest challenges in such a difficult market. So how have you navigated that? Is it finding the right vendors that need to sell and want to sell? Or
Yeah, a bit of that, but also there's an element of experience tells you that when you've got the right vendor profile, inevitably they are working off last year's valuation figures. The market's shifted in a different direction. The cost of money has changed. When you talk sense with good advice and base that on transactional evidence, which we can do because of, we have the benefit of transacting regularly, vendors will listen. Buyers will always want to pay as little as possible. Vendors always want as much as possible, but then inevitably our job as agents is to find the happy medium, which isn't easy. Of course it's not, but the reality is we've been doing it long enough to know how to get there and educate a vendor in the right way and educate a buyer in the right way.
Yeah, and I think that education piece is sort of critical. It's taken us, a bit of time to get there. I think it was late 2022 when we saw the start of the interest rate rises, and quite frankly, and certainly in 23, it was difficult for us as agents to advise a vendor where to sell at, and also advise, a purchaser where to buy at, because it was just the market was changing and it was so volatile. But I think what we found, sort of certainly going into 24, 25, and now into 26, is that we really do understand where the market is at in terms of yields and discount to vacant possession values, and we can really lean into our advice more so than ever. And we have now got vendors and we've got evidence to show where these yields are, and vendors who are listening. And as you alluded to, it's targeting the right kind of vendors as well.
It's so powerful. I can relate to that in the auction world. Is that it's challenging for a lot of agents and valuers in a difficult market where not much is transacting, is that you're then left to opinion. I feel it's probably worth about X, and actually when you can deal with, as we do month to month, hard facts, hard yields and evidence they've actually transacted, and there can be no...
That's the key to it. I mean, ultimately a lot of the advice that we give is relatively brutal, actually, and it's not what you as a vendor want to hear, but it's the truth. And I think when you stand behind truth and the best advice, and you can evidence that as well, and evidence sometimes is a bit limited, but with a bit of knowledge and experience and honesty and truth, vendors will listen, but it needs to be qualified advice, and we do our very best to do that.
We've got lots to get through today in terms of what you have been selling and what's selling well and what isn't. Can you touch on that?
Yeah, so look, typically unbroken C3 blocks within London. If you've got some value add, great. A bit of rental growth as well. But then, aside from your unbroken C3 blocks, portfolios of houses, HMOs, properties with lease wrappers, we sort of touched upon home REIT. And also, we've sold probably around 200 to 250 million pounds worth of operational PD kit now as well in the last couple of years. There is a good market for that now, and we certainly found in the PD space that the stigma attached to PD has sort of gone away now. I think when I first looked at my first PD scheme, which had been converted from an office to resi, it's a old age sort of old office building in the regions where someone has spent £100 a foot on it. But now we're out of that space, and actually institutional money is looking at the PD space as well. So that's been a really good area for us in terms of transactional volume, and then different tenancy types as well. ASTs, well, historically ASTs, which now assured periodic tenancies, and then regulated tenancies as well. So it's a real range of sort of asset types within the resi space and tenancy types as well.
So you sell big unbroken blocks, large scattered portfolios of houses, flats and everywhere, pepper potted stuff, HMOs, and then obviously your Leeds team dealing with the student side of things, that is the purpose-built student accommodation.
Well, we have a purpose-built student accommodation team, but split between London and Leeds, as are the investment team. But we do sell countrywide. So the home REIT portfolio, which we'll reference there, was predominantly based up in the north, but it's spread across the Midlands and down all the way down to the south coast. It was over 700 units. But we sell all over the country. Latterly, the vast majority has been London and the southeast, where obviously investors recognise that there is potentially capital growth and rental growth, albeit maybe not in the short term, but certainly long term. And most of our buyers are holders for the medium to long term, because they recognise the economies of scale when it comes to the stock that's available and the amount of new stock that's coming online, which of course is very limited. So supply and demand dynamic is particularly appealing to an intelligent and selection of investors who are in it for the long haul.
In terms of buyers, is there any common themes with buyers? Where the buyer's coming from, where the money's coming from, what they're looking for in terms of location across here, what yields that? I mean, does it vary hugely? But what are there any common themes you found in the past 12 months?
The money comes from all over the world. There is an obvious exodus of money from the Middle East and from Israel, but that isn't the only source of. We have sold to Middle Eastern, Swedish, Japanese, Australian, Israeli, and obviously UK and American money over the last 12 to 24 months. And as Will referenced earlier, that new money does pop up because investors recognise the advantages of the sector as long as you're in it for medium to long haul.
And I think it's fair to say a lot of these guys that are popping up now, it's they are purchasing offers with a view to holding these properties for the medium to long term. And I think we're at a point now whereby yields within London, certainly zones 1 and 2, are looking as attractive as ever. And we found that you can buy unbroken freehold blocks in some of the stronger zones within London at sort of 7% gross yields. And if you throw in a bit of value add there and rental uplift, then it starts to look really good, really good value. And historically, those yields were in the regions, but I think a lot of the overseas money still sees London and the UK as a safe haven, wealth preservation, and are investing heavily into London now, which we've sort of hugely benefited over the last sort of 12 to 18 months.
And in terms of who are selling and why they're selling?
Well, the recent change in law and legislation around the Renters Reform Bill is, obviously that was impending for some time, and I think a lot of vendors, there's a bit of a theme with retirement, where they've been collecting property, if you like, for buy-to-let investors for maybe 25, 30 years or more. They've seen that horizon coming. They've seen the additional layers of compliance and paperwork that's coming with it, and the new EPC changes as well. And they just, whether they're 60 or 70 or whatever age really, they're sort of thinking, well, quite often their children don't necessarily want to inherit the vast portfolio, and actually they want to find a new home for it, and they feel it's time to pull the ripcord, if you like, and move on. So they come to us for some advice, and we see, and there has been some housing association sales as well across the sector, where I think the challenges with cladding, which is well publicised, alongside the necessity for under AWAB's law for upgrading of their existing stock due to capex and maintenance challenges, they've needed to raise money, and there has been a significant exodus of stock from that sector as well, which we've capitalised on.
And I imagine servicing their debt lines as well is probably more expensive than it was 5 years ago.
Absolutely.
In terms of, I don't know how much detail we're going to go into on it, but we get asked a lot, certainly where I'm sat, from potential sellers and from buyers and from journalists and just general market commentators about the impacts or the likely impacts of the Renters' Rights Act. Too early to really understand what those implications will, how it will shake down?
Yeah, probably a little bit too early, but I mean, in the grand scheme of things, that has proved a catalyst for some vendors to make a decision to move on, but actually it hasn't really frightened vendors into immediately pulling the trigger. But there is a huge quantum of buyers that don't really see it as a problem at all. Quite frankly, they just see it as an opportunity to buy more. Because if it's a numbers game for a lot of our investors, in that if you've got 150 properties, you may as well have 500, because the economies of scale that go with owning 5, 10, 50 units, you may as well have 500, because it becomes cheaper to own management-wise, capex-wise, man in a van, all those costs that are associated with owning a portfolio. What we have noticed is that the smaller investors, in particular, if you've got 2, 3, 4, 5, we did a survey of our investors, and of 1,000, I think something like 50% of those smaller investors saw it as the perfect catalyst for them to just move on. It just wasn't worth the headache to retain that stock.
It's definitely the smaller accidental landlords who have sort of become more affected by it. I think it's business as usual for the larger, sort of more institutional buyers, and actually they see it as an opportune time to sort of buy more. So it's actually quite positive for that element of the market. But as Michael alluded to, those that have sort of got a sort of holding of sort of 15 units, for example, I think it's just trying to understand what it's going to look like in the next 12 months when, your potential rental uplifts will be challenged and what that looks like as well, and the no-fault evictions.
So you're seeing that from both sides, though, in as much as the landlords or the buyers that you're getting have got huge amounts of capacity, already own an awful lot of property, and are wanting to ramp up to scale for that reason of economies of scale or what have you.
Yeah, exactly.
But equally, those that are selling, you are seeing more of the smaller accidental landlords or smaller private landlords that actually, enough's enough.
It makes less sense to have
it,
10 or less, if you like, but it makes a great deal of sense to have 25 or more as a minimum, because then you can start employing people to take the aggravation out of it.
So on that point you were talking about who's buying, are you seeing many sort of genuine new entrants then in that case to the market, or it is those that are already well seasoned in it?
It's mostly seasoned.
Yeah.
It's mostly seasoned buyers that love the sector, have always been in the sector, or maybe are in a second or even maybe third generation of being property investors,
and see other people's uncertainty as a great opportunity where people sit on their hands.
Yeah, I mean, these are very capable and intelligent people who are already set up for owning property in volume, and they're quite happy to have a lot more. So they see it as an opportune time to spend money and to deploy into the sector.
But there was a time when, in terms of the amount of transactions that we facilitated each year, I think, certainly earlier in my career, I think at least 50 to 75% of those deals were with parties that we hadn't dealt with before. I think that's probably flipped on its head now, and I think probably 50 to 75% of the deals that we transact, we've probably done some deals with those parties before, and they've got a much larger holding. And as I say, I think they're just many of these parties making hay while the sun shines, in that last year we transacted deals anything from 2 million to 170 million. So it's often the smaller deals that we're transacting where a lot of these guys are bolting onto their larger portfolios and growing portfolios that way, as opposed to looking for that one large sort of seed resi portfolio. I think people are now bolting onto what the existing holdings that they have.
Interesting. In terms of the big question I imagine a lot of listeners wants to hear about is the pricing. How are you pricing things? What's the evidence suggesting in terms of yields and what have you across those sectors that you
enter into?
So
look, I think the way we fundamentally price kit is it's a combination of yield and discount to vacant possession values. Ideally you want both, but you certainly need one or the other. Now, if we were just talking about sort of central London zones 1 and 2, for example, there is evidence of C3 unbroken blocks now trading on a gross yield basis of around sort of 6.5%. So that's come in a little bit from probably a year ago when it was more like sort of 6.5% to 7% on a gross basis. And then as you go out to sort of more sort of zones 3 and 4, you're typically in and around the gross mark around 7%, and then M25 7.5%. And if you speak to our Leeds office, you talk about the sort of the stronger regional cities, the Sheffields, the Manchesters, the Birminghams. They'd like to see a gross yield of starting with 8%, but we always have to cross-reference this with what the vacant possession values are and the discount to those vacant possession values. So in an ideal world, you would like to see a 20% discount. If you've got the yield, that can be brought into 10 to 20%. But as soon as we start creeping up towards that vacant possession value, no matter what the yield is, it comes back to a bit of a valuation piece, because ultimately who we're selling to now, more so than ever, they are taking out debt. And it just really does need to stack up on a valuation piece as well.
And that's for your traditional ASTs, unbroken blocks or portfolios. Yeah. What about other parts of the market, such as HMOs? Where do you see those yields? London, same regions, London, South East, and the regions.
Yeah, so look, we've transacted HMOs within Gloucester, Yeovil, and Maidstone, and we're talking double-digit gross yields, and 12 to 14%. It is a reality.
Yeah. We're seeing the same.
It's experienced buyers. They understand the leakage from gross to net. There's no sort of fobbing people off. It's just not feasible. They understand that an HMO might leak 40-50% maybe from top to bottom, depending on occupancy rates, where it's located, what the condition is when you buy it, and what obviously all of those things, they all differ in calibre, if you like. But the reality is I think the message is that there are buyers for these things, but they're intelligent buyers who understand the market, and actually you want to be selling to those people because they're less likely to mess you around, because they understand the product and what goes into it.
So I suppose on that as well, HMOs, we've had quite a lot of exposure to that, always do. It's always been, a granular basis, something that's quite popular at auction. And I'm conscious that you've been dealing a lot over the past, longer than a year, 2, almost 3 years, in terms of the social housing side of things and supported living. And there are various opportunities out there with CRC, lease wrappers, and all that kind of stuff. Can you talk, the MERS, all that kind of? Can you talk about that in terms of the appetite for that? Is there enough out there, enough evidence there? How does that impact on yields as well?
We can talk about it, but I mean, not very evidentially, I suppose, in the sense that the ramifications and from the home REIT debacle, if you like, are significant. So there is a very valid and capable element of the market that understands what these lease wrappers should look like and who should be taking these properties off you and how they should be doing it. And they are in the process of being created. There are plenty of them out there. We know people that are doing it and doing it very well with 3, 5 and more longer year leases in place. But the depth of the market from what do purchasers want to buy, the longer the lease the better in an ideal world. With the shorter leases, that there isn't a huge amount of transactional evidence currently to support where the investment upside might be at this stage, albeit we are very much in that sector and talking to a lot of people who are in it to one degree or another.
Because as it stands, I suppose you're still trying to fall back on an investor is on what your vacant possession value is if you're going to let it out individually as HMOs rather than hiding behind the lease wrappers that may or may not fail if the covenant isn't strong enough.
Yeah, the valuation methodology is probably the biggest challenge here because that vacant possession value when you're talking about an HMO, it is debatable. Is it an HMO, i.e. an investable commodity, or is it a house? Well, the argument is that it's no longer a house because you've changed it from a 3-bedroom semi into a 6-bed HMO, which is a very different animal, which is driving an income of £80,000 a year. So is it therefore worth 10% yield, just to make that maths easy, i.e. 800,000, but the house next door sold for 500? So what's the value?
Yeah.
And that's a question for the valuers, and it's a bit of a conundrum that we have to deal with.
It's just the bricks and mortar value, which we struggle with, and getting over that. And I think you can get over that if you've got a strong covenant and a 15-year lease with no breaks. The moment that you're presented with a 5-year lease, and actually when you dig under the skin of it, there's not really a covenant there, then you go back to the methodology of which it sort of comes down to, well, if that falls away, what am I left with? And it comes down to ERV and discount to VPV, to be blunt. But look, there are cases where you can get that covenant and you can get a 15-year and broken term, and that's when it starts to get interesting.
Because sadly, it's a growing sector. It's going nowhere, is it? So it's crying out for.
Yeah, it's a really popular and it's a very necessary sector, and in fact, there's no greater demand for rental accommodation than there is at the sort of the cheaper level, if you like. And those smaller rooms and smaller self-contained units are hotly in demand for rental because they are obviously at the cheaper end, and it's not just privates that want to rent them, it's all the way through the social spectrum. So those people that are in it and understand it and know how to work with the operators in those sectors are doing extremely well out of it, and there will be a time and a place for some significant investment portfolio sales.
I mean, we touched on it a moment ago when we were talking about the sort of factors that are encouraging people to sell and the profiles of your sellers, and you ever so gently touched on it, but the regulation in terms of EPCs, what's coming there and what implications is that going to have on the market in terms of who's selling, who's buying, and what you've got to think about before you do any of that?
It's a difficult question to answer. I mean, ultimately they kicked the timeline out previously on this, and at the moment, I think the horizon is 2030 for EPC minimum for rental. And the challenge is, and we've seen it recently with a very newly converted office block, which is basically a PD conversion as we know them, where a lot of the EPCs were Ds. And actually, when you look at the conversion, it's immaculate, actually a really nice looking building and a really nice flats inside it. Cannot see how that can go from D to C. I'm not entirely sure what you would actually do to change it. So therefore there has to be some more detail, as far as I'm concerned, given to investors in this space in order to understand. I mean, ultimately there is that you spend X and prove that you spent X, and then you can get a certificate of some sort to confirm that you've made the effort to do that. But it doesn't really make any sense to do that at the current time when you've got a building of that sort of calibre that's already been converted and is in perfectly good condition already.
But you're right, that is a catalyst now to lots of vendors who are looking at their portfolio, and this is where I guess some of the sort of investors with larger holdings come in and think, well, do you know what? I've got X amount of properties here which are EPC, D or E, and they weigh up the capex that they would have to spend or potentially have to spend on their portfolio and think, well, do I need this headache along with what's coming with the Renters' Right Bill and what have you, and all the various legislative changes, and they think, well, do you know what? And then it comes to sort of succession planning. Well, do I really want to leave this to my kids and for them to pick up the ball? And I think a lot of our sort of vendors now are sort of looking at that and what's coming down the line and thinking, do you know what? Now's the time probably to sort of pass this on to someone else and let them pick up the ball.
So I'm guessing in a similar way. I mean, obviously, time will tell, and it will play out the way it plays out, but it should be feeding into a little bit like the Renters' Right, playing into people who've got economies of scale and can do things quicker, cheaper, and on scale as a consequence which I suppose is designed by the government, that it's, as they see it, cleaning up the sector so that you've got very professional, in theory, big landlords, which I know there's a big counter to that. The private landlords I've dealt with over the years have been fantastic landlords and great landlords for tenants.
I think that's the frustration. 99% of landlords are very good landlords, because why wouldn't they treat their tenants well? Because at the end of the day, they want them to pay their rent so they can then pay for the mortgage, right?
Yeah.
So it doesn't make any sense at all, albeit I can see why that bad publicity that comes with the very small percentage of landlords that obviously attract that attention has not been helpful. But ultimately, the rental sector has its place, and those that are still buying and are keen to buy are very mature and experienced and capable landlords, and will continue to fill their boots for the long term because they see the future and the calibre of the investment class, which is so very, very strong, and the capital growth and the rental growth that goes with that, albeit with some of those Renters' Reform Bill challenges that come with.
So on that point, talking about the wider market, we've sort of dipped around to different parts of the market, and a large part that's looking back at what's happened over the past 12 months for you guys, and beyond that, where do you see the market right now? And you mentioned there about capital growth, will there be? Rental growth, will there be? Where do you see the market now, and what do you think the next 6 to 9 months will hold? I know it's crystal ball gazing, but...
Well, yeah, but I think it's relatively feasible to do that, because ultimately we've got a government that doesn't seem to be particularly friendly to business and to the sector in the grand scheme of things, and probably slightly unable to work out what to do going forward. Therefore, we have this period of still water. I mean, the market has been difficult for 5, 6, 7 years, starting, going all the way back to Brexit, Trustonomics, Boris, governmental changes, renters reform, Help to Buy ending in October 22, I think, from memory. All of those things have created this perfect storm, and then you've got the cost of money that suddenly jumped when it did, and the reality is it's become the new norm. Yeah. So the market for us is not actually that difficult or complicated. The reality is, if you're thinking about retiring or you're thinking about selling something, we don't really see it getting any better in the short to medium term. So if you are going to sell, we wouldn't say hand on heart, definitely do it now, because it's going to get worse in 6 months or 12 months. But what we can't tell you is that it will get any better in 6 months or 12 months or 24 months. And our honest opinion and our experience certainly tells me that I just can't see the horizon, the positive horizon, to expect a vendor to wait.
I can see a lot, because again, month to month, with auctions and all the rest of it, so I see a smaller scale, a snapshot of that sentiment, and I don't think that's scaremonger in the slightest. I think the reality is what we've learned through the past 5 years, 6, 7 years since COVID, is that all these world events that happen have an impact on the market in terms of general confidence, but ultimately it's the cost of money drives everything. Yeah. If the cost of money has been really static, this is the new norm, it might go up, might go down, that's kind of it. Coupled with reform and stuff coming, it's going to be tougher.
And I think the one thing that we can confidently say at the moment is that there is a weight of money out there wanting to invest in the resi investment space, and there doesn't seem to be any shortage of that at the moment. If you put the right product in the market, there are a number of strong buyers for that product. Now, whether that money will still be there in 12 months, I expect it will be, but certainly at the moment, for the right asset, there is competition out there which is driving pricing.
And also, don't forget, a lot of vendors have had the benefit of either a very healthy income or a very healthy income and capital growth over the
both.
period of ownership. Quite often both. What most vendors want is to know that they're getting the best price at the time of sale, and that's where we come in. And it may not be the price that the valuation or the valuer told them last year, or the bank's valuer told them last year or the year before, but if the market has moved, it has moved. There is an acceptance of that. They just want some qualified, grown-up advice to convince them that the market's probably not getting any better. However, you are getting the best price in today's market based on this evidence, and here's the evidence to prove that.
And I think, just going back to how we market property, I think once we've gone through a marketing campaign, typically when we take anything to the market, we utilise sort of our own databases and yours as well, which we've got over 80,000 active investors there. And for any one sale, we'll have sort of 100 to 200 people log into that specific data room.
Wow, that's
Well, it's meaningful, and what it really helps do is paint a picture to the vendor that we've had a lot of eyes on this. We'll present 5 to 10 offers, and we're confident that everyone that should have seen it has seen it, and this is the best the market's willing to pay.
It's so powerful, that market intel and data.
Yeah,
because we get it day to day like you do in terms of we'll have opinions. And until you can prove one's right and the other's wrong, and proving it with black and white data on, we've got 100 people in, 20 viewings, six offers. This is what it's worth.
You can share that with a vendor and say, look, here are the list of names. Yeah. This is who's been in the data room. These are our top runners and riders, and this is what they've downloaded, and these are who we've spoken to. I mean, it's very compelling.
I suppose also your ability to say, this is a list of people, and we know all of them, and they're good performers or not. It gives them an opportunity.
And when they ring, they speak to us as well. It's partner led, the business. It's not that you can go straight through to not no disrespect to the graduates, but it doesn't go straight to a graduate's phone. It's partners. It's Will and myself. So.
In terms of, dare I ask this, because I hear this all the time in our board meetings, which sounds so frustrating when I work in a fast world of auctions, but length of time it takes to get deals done.
Yeah, it's definitely taken longer than it used to. I think we'd all love to be working in a market, and I remember it sort of a decade ago when attended exchanges were talked about, which never really were attended exchanges, which would all drift into 2 or 3 weeks anyway. But it would be feasible that you'd be getting exchanges done within sort of 5 to 10 days. I think it can still happen. I think, look, the reality now is if you really want to look at a vendor in the eye and let them know the likely timelines, it will take us a good couple, 2 to 3 weeks to get something ready for the market. And now our marketing campaigns can last anywhere 4 to 8 weeks, depending on the size of a lot, and we'll sort of be gauging sort of reaction along the way. But once we do get into solicitors' hands, it's a few months.
And the reality is as well, we haven't really touched on compliance, but the paperwork and the compliance piece that goes with a portfolio or even a big block of PD, if you've got 80 flats or 100 flats or 80 houses,
safety, fire,
PWS1,
fire risk assessment,
key now.
Yeah, I mean, look, you can't get this wrong. It has to be spot on. So, the work that goes on in the background to collect that information up in the first instance, to put it in the data room, it takes a long time, and there's always bits of paper missing with regards to tenancy agreements, EPCs that have expired and need to be redone. When you're dealing with that level of paperwork, it takes time to get it right. And then you want, obviously, at the point of marketing, every vendor wants you to spend a lot of time and effort on one of their prized possessions, and it's right and proper to do that. So, that's a couple of months worth of proper due diligence, and then from there, it goes under offer. Then you've got solicitors that need to check all of that paperwork which you put together. You might have the bank solicitor wants to check all that paperwork. There's a valuation that needs to take place. All of that takes time. Before you know it, 6 months have evaporated.
Which is difficult, I guess, in a very volatile market you've had for the past few years, because by that time comes something else has happened and a reason.
But the key for the vendor is that we have got a qualified party that's buying, and that's what we deliver. And a lot of the time it's, this is the high number, but here's 4 other offers that might be not at that number, but we know those 4.
Yeah.
We don't know number 1. But actually those ones have transacted with us in the past. This is what they did and why they did it and how they performed. And then you can deliver certainty in a potentially quite uncertain market, which is a very valid point you just made there. And that's what a vendor wants to know is, and inevitably Will and I have probably dealt with, if we get 10 offers, which we often do, we probably know 8 of those parties, or 9.
Yeah, it's interesting. I'm conscious of time, and we've been rambling on, and I'm going to throw the curveball that George Walker used to throw at everybody, which is you've got £10 million to spend in the next year on residential investments. What would you buy?
Look, I think for me, unbroken, freehold, C3, within zones 2 to 4 of London. And if you can get some value add in there as well, you know, if there's rooms and car parks which you can develop, refurbishments of flats, if you can go up a couple of floors, given the yields that you can pay at the moment, I don't think you can go too far wrong, to be honest.
If you're holding medium long term, then houses are always a very safe bet, for want of a better expression, in the sense that, you know, if you can buy 10 £500,000 houses and hold them for 10 plus years, I think a lot of our more seasoned and experienced investors will say they've had the best returns on houses.
Yeah.
But you do get a lower yield.
Yeah.
So, and I'm not talking HMOs, I'm talking family,
Yeah.
like small 3-bedroom houses or 2 up, 2 down type houses in and around London and the South East generally, you know, is relatively bulletproof. You get longer rental occupiers, and arguably the biggest leakage on rental is the voids.
Yeah.
So you can minimise your voids, and you know, you get your capital growth and minimal aggravation at the same time.
Very good. Well, thanks, gents. Time to wrap things up. I suppose the takeaway is, if you've got something you're thinking of selling, you want to get understanding where the market is for your asset types anywhere in the country, where the people to speak to, and to make contact with you. So thanks for that, gents. Before we leave, obviously, any feedback you want, any questions you have, any things we haven't covered today, please do email me, Michael or William Shoebotham. Details on the website there. So thank you very much.
Thank you.
Thank you.
Thank you, Richard.